Hello. In this video, we're going to review how to open a new trust accounting and some of the considerations and decisions that you need to make. First, come down to Start New Accounting and select Create New One Trust Accounting. You'll be taken to this screen. The first thing you're going to have to determine is what type of trust accounting you want. The standard accounting or the complex accounting, and you would make your selection. Let's go over the difference between the two. In this slide, you'll see the standard module and complex module columns. So you would select the standard module when the grantor is still alive but not acting as a trustee. The reason being, the grantor is entitled to both income and principal. When a grantor has passed, the trust becomes irrevocable. However, in many situations, a beneficiary will ultimately receive all income and principal, such as when there's an outright distribution, or when there's staggered or interval distributions, or even where the beneficiary holds a general power of appointment. In those cases, select the standard module. The complex module is designed for reporting when there is a legal distinction between the income interest and the remainder interest. Examples of those types of irrevocable trusts: the bypass trust, the marital or Q-tip trust, generation skipping trust, charitable trust. All of these trusts distinguish between income and principal. Here's a couple situations where the income beneficiary and the principal beneficiary are different. The Q-tip trust or marital trust, where income to the surviving spouse, remainder the two stepchildren. Another type of situation, income to a child, remainder to a grandchild. Income to a grantor, remainder to a charity and our charitable trusts. And then you have a couple different situations. Longer-term trust with delayed distributions, where the beneficiary may not survive the term. So if you had a trust where the beneficiary was 35 and there were support payments, income, maybe principal for health maintenance and support for 30 years, and then the beneficiary were to receive all of the principal at that time, or another type of support trust that distributes out upon a satisfaction of conditions, such as testing clean from drugs. This could go on for a long time. In that case, you've got a bit of a crossover because at some point in time, the beneficiary is going to receive all of the income and all of the principal, which would lean towards selecting the standard module. But because it's such a long term and the beneficiary may not survive, there are other beneficiaries who have an interest in the remainder. That leans towards the complex module. The point is, you're going to have to make a professional judgment in these type of trusts as to which module you're going to use, the standard module or the complex module. Now, the good news is you can go for a couple years under the standard module, and then you can switch over to the complex module. So the program itself is very flexible in that regard. Best to make that switch when starting the new account period. Now, let's select the standard accounting module and give it a name, John's Trust. And we'll put in a date, the date the trust was written, 12/1/2000. The acquisition date is going to be the date when the trustee takes over. Let's call that February 15th of 2010. And the tax ID number. All right, when you're entering tax ID numbers in the program, just use the last four numbers of the tax identification number. Well, likewise, when you're entering any identifying numbers, such as bank account numbers, stock account numbers, just use the last four numbers. It's possible that these accountings can get filed in court and become a public record. All right, just coming back to the acquisition date. The acquisition date is going to be the date that the trustee has assumed office, if there's a date of incapacity or a date of death. Are going to be the normal situations. I could envision a situation where the trustee did not take office for some time, and in that case, you'll have to decide what date you're going to use as the acquisition date. Most cases, especially when there's been a death, because the appraisals are date of death, the acquisition date is going to be the date of the appraisals, date of death. All right. The program gives you a choice between the two legal notices that are required to be served with an accounting, the general notice or 16641 notice. And you select that just by using the radio button. You can view what the notice says by selecting the view notice, and you can read it. So the general notice is our 3-year statute. View the 16641 notice. Okay, and you'll notice in here, bolded, 180 days. Now the statutory rule is you cannot have less than 180 days, but suppose that you had a notice of 220. You have to have the specific trust provision providing for this. And there's our 220, and we look at our notice again, the 220 days will appear. So we'll go back to 180 days. Cannot be any less than 180 days. Here you see that the program, the software, has reverted to 180 days. And we put in our start date and ending date. And we filled in the basic information and made the choices that we need to make for this particular accounting. Select Save. You are to return to the main menu. In our drop-down Less Than, we see John's Trust, and we select it. Now we're ready to open that trust and start work on it, and you're taken to the dashboard, and then we have the main menu, general information, beginning inventory, and our other choices down the left-hand side. That concludes this video on how to open a trust.